Welcome to The Explainer. Look, if you're a focused learner, gearing up to completely conquer the ACCA Advanced Audit and Assurance exam, or maybe you're just a professional who wants a solid refresher on rigorous financial verification, you are exactly where you need to be. Today, we're bringing you a high-yield masterclass on designing absolutely bulletproof substantive audit procedures. We're going to take those dense technical auditing standards and transform them into practical, undeniable strategies that you can start applying literally today.
But first, I need you to ask yourself honestly, are your audit procedures actually bulletproof? In an advanced audit scenario, vague answers like check the invoice or go talk to management simply are not going to survive the examiner's scrutiny. No way. You're expected to act like a senior auditor. You need precision. You need highly verifiable actions. By the time we wrap up this explainer, you'll know exactly how to craft procedures that leave absolutely zero room for doubt.
To get us there, we've got a tightly packed agenda. We'll be conquering 5 critical risk clusters today. First, the masterclass mindset. Second, subjective risks. Third, complex obligations. Fourth, tangled agreements. And finally, financial instruments.
Okay, let's dive right into this. Starting with Section 1, the masterclass mindset. Before we can tackle the specific accounts, we really have to align our thinking with the core objective of an auditor.
You see, a substantive procedure isn't just some random spot check. It's a targeted strike designed to detect material misstatements right at the assertion level. Basically, we're asking, does this asset actually exist and is it valued correctly? Every single procedure you write has to contain a clear action, like inspect, recalculate, or independently verify, and it has to target a very specific piece of evidence. We can't just guess, we definitely can't assume, we literally have to outline the exact steps required to prove or disprove the numbers sitting in those financial statements.
Let's apply that exact mindset to our first major danger zone, Section 2, subjective risks. This is where management's judgment comes into play, creating massive audit risk.
Let's look at some rapid-fire procedures for accounting estimates and fair values. Management loves to be optimistic here, right? It's kind of funny how their internal estimates always seem to paint a rosy picture. So the absolutely crucial point for us is independently verifying the assumptions behind those numbers. You've got to review exactly how management came up with their estimate in the first place. You have to rigorously test the raw underlying data they used. Are their assumptions actually aligned with current market conditions? Or are they just living in a fantasy world? And hey, never forget the ultimate cheat code for an auditor, checking subsequent events. What actually happened after the reporting date? That often gives you the truest, most undeniable picture of an estimate's accuracy. I mean, it's pretty hard to argue with reality.
Now, moving on to goodwill and impairment testing. Because goodwill is an intangible asset representing future economic benefits, it is incredibly risky and entirely subjective. You've got to treat this as a rigorous, step-by-step verification of future value. Step 1, ensure management has correctly identified their cash-generating units. This is huge because shifting underperforming assets between units is a classic accounting trick to hide impairment. Step 2, you must compare the carrying amount of that unit to its recoverable amount. And step 3, this is where auditors truly earn their keep. Verify those cash flow forecasts. Are their projected growth rates mathematically sound and historically realistic? Or is management just wearing rose-tinted glasses to avoid a massive write-down? Challenge everything.
All right, let's see how this builds into future unknowns as we enter Section 3, complex obligations. We're tackling provisions, contingencies, and deferred tax.
And this brilliantly illustrates the battle you'll face over probability. When dealing with provisions and contingencies under IAS 37, it's basically a strict matrix. If an outflow is probable, meaning it's more likely than not, you have to ensure they recognize a provision directly on the balance sheet. Naturally, management will often try to downgrade this just to avoid taking the hit to their profit. Now, if it's only possible, your procedure is to confirm they've disclosed it as a contingent liability in the notes. If it's remote, no action is required. Your audit procedures here must cut through the noise. You need to be inspecting legal correspondence and board minutes to independently confirm exactly which of these 3 buckets the obligation actually falls into.
Next up in the complex obligations bucket, deferred taxation. Regulators scrutinize this area heavily, so your procedures have to be strict. First, you need to independently recalculate the temporary differences between the accounting base and the tax base of the specific assets and liabilities. Second, verify that management is actually using the correct, substantively enacted tax rates. Not just a rate they're crossing their fingers will pass next year. But the final point is the absolute key. Assess the probability of future taxable profits. Why does this matter? Well, a deferred tax asset is practically worthless if the company goes bankrupt or fails to generate a profit before they can actually use it. Future recoverability is your ultimate test here, so make sure you inspect their long-term profit forecast with extreme skepticism.
Let's step right into Section 4, Tangled Agreements. Time to unravel the complex web of contracts that govern revenue and leases.
Revenue is almost always a presumed fraud risk, right? Companies are under immense pressure to hit their targets. So to bulletproof your procedures under IFRS 15, you follow these sequential steps. 1. Physically inspect the contract terms to see what was actually agreed upon. 2. Clearly identify the distinct performance obligations. What exactly did the company promise to deliver? 3. Verify how the transaction price was allocated to those individual promises. Do they artificially inflate the price of the item delivered today while heavily discounting the service delivered tomorrow? And 4. Well, this is where most frauds actually happen. Confirm the timing. Did they recognize the revenue at a point in time or over time? Your job is to obtain hard evidence that the timing of revenue recognition perfectly matches the actual transfer of control to the customer.
Now, what's really interesting about this slide is how under IFRS 16, auditing a lease forces you to fight two completely distinct battles. It's notoriously an area where companies get the accounting wrong all the time. On one side, you attack the right-of-use asset. Your procedures here are somewhat traditional. Verify the physical existence of the leased asset and assess if its stated useful life is actually reasonable given the lease term. On the other side, you attack the lease liability. This requires complex financial recalculation. You must independently recalculate the present value of the future lease payments, and crucially, you have to verify the appropriateness of the incremental borrowing rate management used. Because think about it, if they use a rate that's too high, it artificially shrinks their liability. Two sides of the exact same coin, requiring completely different audit techniques.
Which brings us to the final section of our explainer, the final boss of our masterclass, financial instruments.
This is a highly complex, heavily scrutinized area under IFRS 9 that requires utmost precision. To neutralize the massive risks here, you've got to execute these procedures flawlessly. First, confirm the classification. Inspect management's documented business model to determine if the instrument legally belongs at amortized cost or fair value. It's not a choice, it's based on facts. Now, if it is fair value, do not just blindly trust management's complex internal spreadsheets. Those models can be tweaked to show whatever profit they desire. You absolutely must obtain independent third-party valuations to verify those numbers objectively. Finally, grab your calculator and independently recalculate the effective interest rates to ensure the finance income or expense recorded in the P&L is dead accurate.
So, we've covered the critical risk clusters, and you now have a solid toolkit of bulletproof substantive procedures. But you know, having the tool is only half the battle. The real test is knowing exactly when to use it. So I'll leave you with this final challenge. You have the procedures now, but when you're staring down a dense, complex scenario, can you spot the underlying risks before the examiner does? Keep this mindset active, apply these steps rigorously, and you are going to absolutely master your next audit challenge. Thanks for joining me on The Explainer.